Hi, this is Pondit Bookkeeping Services, where we talk about accounting for your business. In this video, I'm answering another question, and this time it's about how do I manage my cash flow. Okay, so talking about cash flow in your business, there are a few angles I would want to come at it from today, and the first one is your credit policy. Okay, what kind of business do you run? Is it a kind of business where you have to give your customers credit? That is, they pay you, they buy now and they pay later. Okay, if that's the kind of business, or if that's the kind of model you're running, where they enjoy the benefits first before they get to pay, now you need to now ask yourself a question. What about my own suppliers? Am I going to pay my suppliers cash and carry? Right? So if I'm paying my suppliers cash and carry, and I say I want to give my customers credit, then how am I going to fund the cash and carry from my suppliers? So I need to pay my suppliers cash to pick up my goods, but I'm not giving, rather my customers are not paying me cash before they take my own goods. That's usually where the problem starts from, because you see, you need money from your customers to be able to repurchase, except of course you are funding the purchase either from a loan that you have collected or your capital, right? So if you have sufficient capital, then yes, it could work. So it's important to understand your own circumstance. Do not just jump on a bandwagon because you see that's how every other person is doing it. Okay, so these are in the considerations that you must sit down to think about before diving into your own business dynamics. Okay, if my customers are going to pay later, then how am I going to ensure that there is a steady supply of goods to even sell to them? How am I going to be able to meet up with my own supplier obligation? Alternatively, you could, if you have built a relationship with your own supplier over time by maybe doing cash and carry consistently, you could go and take advantage of that relationship. I'm saying take advantage in a positive way by having a discussion. A number of issues are usually resolved over discussions, candid discussions. So you could tell this supplier of yours that I'm trying to get more people to patronize my business, and I see that giving them certain days interval to pay me after taking the items is attractive to them. It makes them patronize me more. So can you also give me some time in settling you? So I pick up the goods and I settle you after I've also collected cash from my customers. So my customers pay me back in 20 days. Can you allow me 30 days? So that give or take, if 20 days turns to 25, then definitely in 30 days time I will have the money to pay you, my dear supplier. Okay, so that's a conversation to have. So because managing your receivables, which is your customers, and your payables, which is your suppliers, is a very critical aspect of managing your cash flow. If you get it wrong, if you are under pressure to pay your suppliers and you haven't gotten all your monies in from your customers, it means that you have to borrow, and there is a cost of borrowing that also eats into your net profit, the interest, because you're not just repaying principal, there will most likely be an interest portion. If you cannot fund your supplier payments from capital or loan borrowing, explore having credit days from your suppliers so that your customers, you can serve the customers and still also meet the supplier expectations. That's one angle. The other angle is to start off doing cash and carry with your own customers, because you're just starting and because you don't have as much muscle to get supplier credits in place or loan facility in place, right? So collect cash from customers, then buy your goods. So it's a slower way, but then it's less stressful, okay, and you won't have these unnecessary headaches and palpitations of the heart because you are unable to meet up. Okay, so that's really it. Then the other thing to also consider in managing your cash flow is try not to tie your money in slow moving stock. So you need to have understood your customer buying patterns. Take time to understand your customer buying patterns, know which items move the most, and those are the items you want to stock up on, right? Because if you put your money in slow moving items or even items that don't move, you are tying down cash that you could have used to generate more sales on fast moving items. And the more you turn around your cash in terms of purchasing goods, selling, the more profit you get to accumulate over a period. Okay, so that's what we accountants call the sales turnover ratio. Okay, so you need to be able to ensure that you can turn around your investment in inventory as fast as possible, right? So if you spend 1 million to buy inventory at a particular time and you can turn it around in 3 months, right, get your 1 million back plus the profit that would have accumulated. Let's say it was 250,000, so 1 million 250,000, right? And so meaning that you can do that 4 times in a year, right? But imagine that you could turn over that 1 million 6 times in a year. That's every 2 months. It means that you are getting more profits. Okay, you're getting 250,000 naira times 6 times as against 250,000 naira times 4 times. So it's critical the kind of items you invest in terms of inventory. Okay, they need to be fast moving items so that you do not have cash tied down and you do not have cash flow problems. So we talked about fast moving inventory. We've talked about managing your receivables and payables, getting them to be in sync. Okay, the other thing too is keeping your costs low as much as possible. Yes, so this is what I typically say. I say that there are many things good to have in business, but you don't have to purchase everything today at once. You can pace your spending. All right, so you don't have to do furniture replacement, generator replacement, pay the rent all in one single month, right? Pace it, pace it to the timing of your cash flow, and which is why record keeping and accounting is important. If you are not keeping records, you won't know in which periods you get the highest cash inflows. Okay, so if you know which periods you get the highest cash inflows, then you can push the bulk of the expenses in that period. All right, so that when there are periods with lower cash inflows, you're not spending as much. So you are actually pacing your spend in in relation to the timing of your cash inflows. That helps you, right? So have a record of your expenses, plan them, okay, and that's where budgeting also comes in place. So you are budgeting ahead of time because you have already studied your patterns. You know which periods to have the expenses pushed to and which periods where you have lower expenses incurred. Now, if you plan your spending using budgets, okay, then you are not under constant cash flow pressures because you know when everything should take place. Okay, so it comes with some organization, some coordination, and yes, you may not be able to do it yourself. Seek help if you need to, but these are some of the things you need to consider in managing your business cash flow. Okay, so I hope this was helpful. If you want something more specific to your situation, then use the link in our bio to book a consultation, and we will be happy to have a discussion with you in that regard. You could also send us an email, info@punditbookkeeping.com, and we can take it up from there. All right now. Thank you.